Hey friends, I'm back. I want to share in the video today the three major types of dividend stocks that I am buying right now in 2025. There's three major categories, and I want to share an example in each category. Two of the examples are stocks I own. One of the examples is a stock I plan on buying soon. It's on my watch list. It's on my buy list. And so let's get started. The first category that you can see right here behind me on the whiteboard are these core ride or die dividend stocks. This is really the category of investing, the category of stocks that started my personal journey as a dividend stock investor. These are those anchor positions in the portfolio. These are those positions that allow me to sleep well at night. These types of positions, typically, I will dollar cost average into them, and I will oftentimes feel good dollar cost averaging at almost any price because they traditionally have traded within ranges of value. Now, I get more excited when they're on sale, and I try to average in more when the stocks are on sale. But these sleep well at night stocks, like the example I'm going to share today, which is Coca-Cola, by the way, they tend to trade within a range of value over time. Now, I like to reinvest dividends. I'm going to share a link in the pinned comment below to my Patreon. On Corner Patreon, I share my portfolio, and I share the percentage allocation to each position. And my Corner patrons already know many of my positions I reinvest automatically, others I do not. Typically, with these core stocks, these ride or die positions, I like to reinvest the dividends in perpetuity. That's just how I approach them. Again, because oftentimes with stocks like Coca-Cola, they're within a range of value that I'm okay buying. Now, this is what I like to refer to as get rich slowly. This is certainly a long road to wealth. It's disciplined. It can take time. The reinvestment certainly helps in the system, but it takes time. A lot of the time, these stocks can trade sideways. There can be periods of slower growth, but year after year after year, the compounding eventually happens. And in the example today that I'm going to share with Coca-Cola, it actually recently became a rocket ship. This stock had a really, really solid 2024. Now, the reason I share videos here on YouTube, this is just my personal journey, it's not financial advice. The reason I share these videos is to describe my journey as a dividend investor. And the reason I invest is for cash flow. And with this first category of stocks, these anchor stocks, these core stocks, ride or die stocks, typically the cash flow from day one, it's okay, but it's really in the medium term when the yield on cost can get a little bit better. It's kind of the medium term, and when I say medium term, I'm talking 5, ideally 10 plus years of the dividend snowball doing its magic. Over that time period, meaningful cash flow can start coming to the investor like myself, and I can use that cash flow to pay bills, but I'm really deferring that at this point with the core stocks because I do like to reinvest dividends. And I'm still at a position in my life where I don't have to tap into the cash flow, and so I keep it reinvesting with stocks like Coca-Cola. But let's look at that example. Let's look at this example of a core ride or die stock. And so as you can see on the screen in front of you right now, this is the recent earnings report from Coca-Cola. It was amazing. And I actually shared some thoughts about this over on Blossom. I'm going to link in the pinned comment below. Blossom is a social media platform for investors, co-founded by my friend Brandon Beavis. It's a really cool platform, and that link in the pinned comment below, in terms of full disclosure, is my affiliate link. I'm compensated for those of you who sign up through my link, but it is free to use the platform. They have paid tiers as well. But I shared some of my thoughts about this earnings release on Blossom, and the thoughts really were, wow, this is tech-like results from a core ride or die stock. And so in particular, let's look at a few of the metrics on the screen in front of you right now. Let's look at this. Net revenues grew 6% for the quarter, 3% for the full year, and the full year is 2024. Now, organic revenues, non-GAAP measure, grew 14% for the quarter, 12% for the full year. amazing. Top line growth is rivaling tech stocks. And I'm actually going to talk about a tech stock today. So stay tuned. This is in the third category today, the third segment, that I'm going to discuss a tech stock that I plan on buying. And no, it's not Alphabet. I already own Alphabet. This is another one. But stay tuned. Anyway, I'm just going to drop down to EPS because at the end of the day, earnings per share is one of the metrics I like the most. And cash flow as well. But let's start with EPS. Fourth quarter EPS grew 12%. The non-GAAP EPS grew 12%. For the full year, EPS declined slightly, but the comparable non-GAAP grew 7%. Free cash flow, excluding the IRS litigation deposit non-GAAP measure for the full year, was up 11%. And so that's probably the bottom line there that I want to share. The free cash flow is growing, non-GAAP measure, about 11% year over year. And so Coca-Cola right now, yes, it's a core anchor ride or die stock, but they're seeing a renaissance, if you will, within their business. It is just surging all of the sudden and doing quite well. And sometimes people discount stocks like this. Ian, you're a boring investor. Ian, you're just buying those old school blue chip stocks. Well, maybe I am boring. Of course, I don't share any advice. I'm just sharing my personal journey, but this is what works for my level of risk tolerance. And most of my dividend stock portfolio is built around these core stocks like Coca-Cola. In fact, as you can see on the screen in front of you right now, I just want to share a few metrics from my personal experience with Coca-Cola. I started buying this stock in 2011 at $31.19. Now it is at $68.87. And so yeah, the capital appreciation over all those years, it hasn't been huge, but it's like I said, core steady anchor. I sleep well at night. It's slow growth, but it works for me. And what I love the most is my first tranche, simple yield on cost, not including dividend reinvestment at all. Even though I am doing reinvestment, just to illustrate a point here, it's up to 6.2%. And for me, that is kind of I'm getting into the longer term here, but it's just past that point of kind of a medium term hold. I've only been in it since 2011, and I'm already yielding 6.2% yield on cost without factoring in reinvestment. And that's meaningful cash flow to me coming from a sleep well at night stock. And so category one, that's really the foundation, the anchor of my portfolio. I want to talk though about another type of stock that I own in my portfolio, and this is category two. You can see here it's in the green. The first one was in blue. Now I've got the green. These are the high yield dividend stocks. High yield dividend stocks tend to carry increased risk. It's more difficult to buy high yield stocks because in my experience, it's important to buy them when they're on deep discount, when there's clear value, and I can buy at a price point where I'm building in a margin of safety. There's this concept that Benjamin Graham made popular in his literature that Warren Buffett followed very closely and continues to follow throughout his career, and it's this concept of margin of safety. And you really want to buy a stock at this level when you know it's kind of worth this level. It's a margin of safety. This is very important with higher yield stocks that tend to carry a little bit more risk, because if you just buy them at fair market value or even above market value, it's not like these evergreen ride or die stocks. They're not growing the business necessarily very quickly over the years. It's more of an opportunity to get a business that's trading at a low level, paying out a lot in terms of cash flow, and just kind of land grab, getting all that cash right away to pay the bills. And so with something like that, with more risk, the market can be less forgiving. And so what I said in blue category one, I'll kind of buy and generally feel that it's in a range of value. I'll reinvest, auto-reinvest at any point, because I know if I let the decades pass, Coca-Cola up and to the right, in my personal experience at least, just speaking my personal experience. But I'm going to use the example British American to illustrate this category in green, these higher yielders. British American has had a lot of risk. It's a sin stock. It sells a product that governments around the world, certain groups, certain people, they don't like. They look down on it. I believe in free choice. That's why I invest in this category of stocks, and I believe people should be free to enjoy their life and use the products with discretion and with moderation and to do their own research. But anyway, there's a lot of things going against this stock. But you'll see in a minute, the earnings report, they are growing very slow, very minimal growth, but it's not good enough for the street, and the stock did go down this week. And I wanted actually to share this British American example because I bought it with a margin of safety. When I bought this, I'm going to share in the pinned comment below a video I did when I bought my shares. Most of the recent tranches were in the $33 range. Anyway, it went all the way up to the low 40s, but now it's dropped down, I think, to around 38s, and it plummeted on the earnings report. I didn't think the earnings report was that bad, but I think some investors, some analysts did not like that there is litigation risk in Canada and the risk of a big settlement there. I don't think also that they liked the forward guidance, that it's just really slow, steady Eddie, kind of 1-2% growth. It's nothing that exciting. What did I do right with British American? I bought it low. I bought it with a margin of safety. It's so important with these higher yielders that have more risk. If I am to buy them, I buy them with a margin of safety. And a lot of investors out there, they may not even want these types of stocks. It may not make sense because the risk profile is higher for these kind of things. But again, I built the core of my personal portfolio with category 1, and that allows me to venture out into some of these more risky stocks. The other thing I do, it's very different with category 2 versus category 1. What's so different for me is I don't auto-reinvest these stocks. In fact, with the sin stocks, they're really the high yielders in my portfolio right now. I have a few others. I have Pfizer, for example, which is also kind of a higher yielder, if you will, within the pharmaceutical space. I don't reinvest the dividends. I'm pulling those dividends out. The reason I pull the dividends out is I am de-risking the portfolio, because eventually I will pull out everything I put in, and then what's left is, so to speak, on the house. And so that's how I look at this category of stocks. But as you can see on the screen, check it out. Let's just look at this BTI earnings release. It wasn't very good at all. As you can see in the summary, the organic revenue at constant rates, it was only up 1.3%. Now, thankfully, new categories grew 8.9%. That's why their business is doing as well as it is. Adjusted organic profit from operations at constant rates is up 1.4%. Reported diluted EPS, adjusted organic diluted EPS is up 3.6%. Dividend growth only 2%. So on and so forth. It's a pretty boring earnings report. I didn't think the stock would tank on it because I feel it's already trading at bargain basement levels. Certainly it was when I bought it in the 33s, but even in the low 40s, I still feel like, hey, it's trading at a discount. I thought most of these factors were priced in. Apparently Wall Street didn't agree. The stock went down, but thankfully it's still higher than where I bought because I locked in a margin of safety. When I look at a stock like Coca-Cola, which is in the first category, I'm looking for long-term dividend growth and yield on cost over time. And I'm looking somewhat for this kind of concept. Even though I don't plan to sell, I'm looking for total returns. With category 2, BTI, I'm not really looking for anything from the stock. I don't really expect the stock to go up over time. I kind of look like money in, that's it, I'm never going to sell. I'm never going to sell anything, but in particular with category 2, I'm really cautious about how I look at stock price. But what I do hope for in category 2 when I do my analysis, if I do my analysis correctly, is that they can continue to pay the dividend in perpetuity. And so that's just another way I look at this category of stocks. But as you can see on the screen in front of you, just a few fun stats about my experience with BTI. And so, as I mentioned, I bought a lot recently in the 33s. I locked in a dividend yield in the 9% range. In fact, my corner patrons already know this, but it's now my number 6 largest position. It's 5.29% of my portfolio and 11.47% of my dividend income. Certainly, I have a concentration of risk there. I've probably taken on too much risk, and that's why I'm de-risking by selectively reinvesting those dividends elsewhere and by using some of them to help pay my bills. Again, I saw it climb all the way up from 33 to 42. It's now at 38.82. Even though it tanked on earnings, I'm still up due to the margin of safety. Okay, so that's kind of category 2. By the way, if you're enjoying the video so far, please go ahead and click that like button, and also head down to the comments below and share if you own either of these stocks, Coca-Cola or BTI, or if you don't, do you own any of these stocks that are either kind of core sleep well at night stocks or in category 2 of the higher yielders, the riskier stocks like BTI? Okay, the third category of dividend stocks that I want to speak about today, as you can see at the bottom, it's in the purple. These are kind of the true dividend growth stocks. Of course, Coca-Cola is a dividend growth stock. But when I think about dividend growth stocks in 2025, what I'm really thinking about are stocks that have more exposure to true growth trends that are growing quicker. They're kind of compounding very quickly. They have higher PE ratios, but they're growing quickly over time. I'm going to give an example today, and it's a REIT actually. Believe it or not, this is a REIT I'm looking at, Real Estate Investment Trust. I'm looking at it very closely. I plan to initiate a position at some point. The only reason I have not already is I'd rather put those same dollars into SCHD, which is my top priority of the year. That's an ETF, but it would probably fall into bucket 1, core ride or die. Or I'd rather put the dollars into Alphabet, ticker GOOGL. But anyway, there's a data center REIT called EQUINIX. EQIX is the ticker, and the price per share is like up in the 900s, so it's expensive just to buy one share of this stock. It's an interesting company, but they provide data centers around the world, which are critical in our kind of renaissance here of AI, artificial intelligence. What is unique about EQUINIX is in their field of work, they have arguably the best financials. They are a really solid company that is very well managed, and arguably their technology is some of the best. If I understand what I'm reading, and I may not, but the research that I've done so far shares that with EQUINIX, if they have two different customers, big companies, they can kind of speak to each other on these data centers in real time with next to zero latency. That's my understanding. And so not only is the company operated with excellence, with efficiency, but also the technology that's there, it's not just a commodity. A lot of data centers in the REIT space are treated just as commodities, and it's hard for them to increase rental rates on their customers. But with EQUINIX, my understanding is they do have some pricing power over their customers because what they offer has this network scale, these network benefits, and that there's a kind of secret sauce in terms of technology. Obviously, I'm still doing my homework, but it comes with a very high PE ratio, and I'm going to get to that in a minute. But before I do that, let's just start. What is this third category of stocks? What is it all about for dividend investors like myself? Well, these stocks tend to have a longer time horizon required. And so I don't really look at them necessarily as more risky than category 1. I kind of look at risk levels almost at parity. I think category 1, category 3, is one more risky than the other? Maybe category 3 is more risky for someone that has a really short-term horizon, but for someone like myself who's looking longer term, I wouldn't buy for myself personally something in category 3 unless I had decades upon decades in the future that I was looking forward to. But for me, I don't feel like there's a lot of risk. With category 2 higher yielders, I actually feel the risk, and that's why I de-risking by taking the money out from the dividends to eventually fully de-risk the positions. But category 3, what is so unique about it is the yield does not come in the medium term. The yield does not come in the short term immediately. The yield, it comes way out. It comes way out because the investor relies on yield on cost, on compounding, on many years ahead. And in bucket 3, I'd say it's more of a total returns as well opportunity because these stocks, these companies are growing so quickly that not only will the dividend grow, but the share price should appreciate in parity over long periods of time. I'll give you that example of EQUINIX again, 2% starting yield. That's not going to cut it for me. It's not going to be a starting yield that is, for a REIT especially, that's a low starting yield, but it's growing very quickly. And so the way I look at category 3, these are stocks with rapid growth. I need to look at them as, hey, I'm not really making any meaningful cash flow for a very long time. In terms of dividend reinvestment, honestly, the dividend is so small that it probably doesn't matter whether I reinvest it or not. On a lot of these stocks, honestly, because the payouts I'm getting are lower, for my personal situation, I'm not reinvesting them. I'm just kind of pooling those dividends together until I can make a bigger selective reinvestment back into one of those high growth stocks, or another stock, maybe a core stock in category 1 that might be on sale at any given time. By the way, I don't believe Coca-Cola is on sale right now for my personal situation. I don't believe really BTI is on sale. If it got down to 33 again, maybe it would be. And honestly, with EQUINIX, I don't believe it's on sale either, but that's kind of a point I want to make about category 3. These ones are really difficult to time. I'd say category 2, it's super easy to time. It's either on sale or it's not. I knew BTI was on sale in the 33s and I went in. I know a lot of you in the community bought even lower. Put in the comments below. I had people writing in, hey Ian, I bought it way lower even than you. That's so cool. Put in the comments below. I'd love to hear about it. Category 2 is easy to buy on sale because it's really it's a simple analysis. Category 1, honestly, is easy to buy on sale as well because they typically trade within value ranges, and then sometimes there's more value than others. We've seen this with stocks like PepsiCo, for example. Category 3, it's a little difficult. I think Alphabet's on sale right now, but some argue it's not. It's more up for debate. There's an art and a science to it. I guess there is with all of it. In category 2, I certainly think there's an art and a science, but maybe in category 3 as well. EQUINIX, for me at least, it's one of those things where it's trading at a PE equivalent on AFFO, adjusted funds from operations, of about 25. Is that on sale given its growth? Is it not on sale? Is it at fair value? It's harder to tell. Will it ever be on sale? Probably not. I'll show you why in a minute. Ought I to buy it at a PE equivalent of 25? Probably. And so that's where category 3 is so different than categories 1 and 2, where you might not see it on sale quite as much. Now, there are exceptions. There's certainly exceptions. Alphabet, I think it's on sale right now. About a year ago, it was really on sale. And so some investors jumped all over that, and good for them. Put in the comments below if that was one of you. But anyway, let me keep going. So as you can see on the screen in front of you right now, this is the earnings report recently from EQUINIX. And these numbers are just fabulous. They're showing record full-year bookings, which is honestly not something new for this company. I'm going to get into this. Oh, actually, I'll just get into it right now. One of the things that I read about on EQUINIX in their report and on their website is they have had 22 years of quarterly revenue growth. So it's always a record for them, I guess. Let me repeat that. For the last 22 years, to my knowledge, based on what I've read, this company sequentially, every quarter, has grown revenue. That is what I'm talking about with rapid growth. Coca-Cola, core ride or die stocks, they grow. They tend to grow over time, slow and steady. But it is not always like clockwork. There can be plateaus, long periods of time where it plateaus a bit and then it goes up again like Coca-Cola is now. But EQUINIX, every last quarter for the last 22 years, this thing has been growing. Let's keep going. As you can see on the screen, though, from their recent earnings report, let's just look at this. Annual revenues, 7% up on an as-reported basis, or 8% on a normalized and constant currency basis. I have some other metrics that I wrote down that I'll just talk about as well. AFFO, adjusted funds from operations. This is a key statistic I look at from REITs that I own. It is up 10% on a normalized constant currency basis. And they just did a 10% dividend increase. And dividends are not qualified for REITs. So it's more of a, I like to call these distributions, but it's called a dividend in their report. For 2025, they're estimating AFFO growth of 7 to 9%, and on a forward basis, on the bottom end of their range, it puts the PE at about, AFFO PE that is, at about a 25. What I want to close with on a stock like EQUINIX, and a realization I've had, look, you all know if you've been watching my videos, and if you haven't, please, welcome, and please subscribe to my channel. It would mean the world to me if you click the subscribe button and become part of this community of dividend investors. The best part of the community is the comments section below. There's so much, or at least one of the best parts, but one of my favorite parts. I love looking at all the comments. I try to respond to most of them, but what I want to share, my journey is evolving. You know, this year, if you've been around for a while, my goal, SCHD. It really falls more into bucket one. Once that gets up, though, to about 10%, 20% of my portfolio, and this year it's my focus. Next year it will be too, but it'll phase down a little bit. As I get towards the latter part of this year and into 2026 and certainly into 2027, I want to ramp up bucket three a bit, with a tech focus. I'm starting with Alphabet this year. Next year, or even late this year, might include EQUINIX and others. I have a few others I'm looking at right now. I'll share those in subsequent videos. But I want to ramp it up. And the key last takeaway I want to share is kind of, I personally feel it's a risk if I do not own these stocks. If I do not own some piece of the AI future, of the tech future, of the high growth. And of course, it has to be backed up by numbers. I'm going to share an example. Meta. This is a stock I don't own. Meta right now, it actually has a PE. And a reasonable PE, somewhat reasonable. I don't remember exactly what it is, but when I looked at it recently, it was like in the 30s or something like that. A long time ago, I was looking at Meta, way back. Oh, it's probably maybe 10 plus years ago now. It was not so long after it IPO'd. I could not rationalize buying it because at the time, either the PE was non-existent or it was just so astronomically high that I couldn't wrap my mind around it because I'm a fundamental investor. I'm a numbers guy. And so for me, I'm talking about bucket three. Maybe Meta would fall into that bucket now. Probably not unless the PE got down a bit into the mid-20s. But what I'm saying is I have to be able to get my hands around the numbers. And it has to have reasonable numbers. It has to have the growth as well. And it has to have a dividend and a growing dividend. I'm buying it for the dividend. These are types of dividend stocks. I'm a dividend investor. EQUINIX is starting at 2%. Alphabet's at like 0.4%. But I believe Alphabet just started a dividend, so who knows what their policy is. Hopefully they'll grow it over time. I believe they probably will. But with EQUINIX, I know their policy is of dividend growth. And so that's a key caveat that I want to share with category three. And it's a risk if I do not own them. But again, I'm kind of projecting out to what I want to accomplish in 2026 and 2027. Right now, in the short term, I just want to bolster my cash flow, and I'm doing that with SCHD. And honestly, I'm getting the growth out of that too. SCHD, in some ways, because of their algorithm, I believe it combines categories 1, 2, and 3 in some ways without all the risks that come from category 2. It has a higher starting yield. Somewhat higher, but these days I guess it's more comparable with the category 1, but it has the dividend growth comparable to category 3. And why is that? The algorithm rebalances the stocks, and so far it could always change in the future, but that algorithm has worked quite well at optimizing for starting yield and dividend growth. But a lot. This is a lot, I know. And so with all of that, I want to end the video today. Thank you so much for watching. If you did enjoy the video, please click the like button. It means the world to me. And before I go, in terms of a full disclosure, I own the stocks mentioned today. I am long Alphabet, ticker GOOGL. I am long Coca-Cola, ticker KO. I am long British American, ticker BTI. I am long Pfizer, ticker PFE. Also, I am long the ETF SCHD, and EQUINIX EQIX is on my watch list. I plan to start a position, initiate a position in that company at some point. Before I go, today's video is not financial advice. I'm not a licensed financial advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. I'm just sharing my personal journey for fun and entertainment. And if you are going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first before making any financial decisions. As always, I have my full disclaimers in the video description below. Thank you for watching, everyone. I appreciate it. I'm going to see all of you in the comments below, and I'll see you in the next dividend stock investing video.